Great, good afternoon, and thanks everyone for joining this launch of the World Economic Situation and Prospects Report, a flagship report by the UN Department of Economic and Social Affairs. And we have with us three distinguished speakers: the Undersecretary General for Economic and Social Affairs, Mr. Junhua. Next to him, the Director of Economic Analysis and Policy Division of UN DESA, Mr. Shantanu Mukherjee. And on the far end, Mr. Hamid Rashid, the Chief of the Global Economic Monitoring Branch in UN DESA. So I think we'll get started right away with some introductory remarks by Mr. Lee.
Thank you. Thank you very much. Well, distinguished friends of the press, good morning to you. Well, good afternoon. And Happy New Year to all of you. Today, my colleagues and I are very pleased to welcome all of you to launch this 2025 edition of the World Economic Situation and Prospect Report. As you know, this flagship report is prepared by DESA, Department of Economic and Social Affairs, in partnership with UNCTAD and the 5 UN Regional Economic Commissions and the UN Tourism Organization. So at the outset, let me take this opportunity to express our sincere thanks for our partners. I just want to highlight the one key observations before I go into the details. That is, our current assessment indicates that the world economy has largely avoided a broad-based contraction despite the unprecedented shocks of the last few years and the most prolonged period of the monetary tightening in the history. So for the 2025, our projection is that the global growth will be around 2.8%, similar to the 2024. Lower inflation, monetary easing, and the recovery of the international trade underpinned this relatively stable outlook. Nevertheless, we know that this rate remains well below the pre-pandemic average of the 3.2%, the recorded over 2010 to 2019. The recovery remains uneven, driven primarily by a few large economies. Subdued growth prospects pose significant challenges, particularly for the developing countries. Growth in over 90% of the least developed countries is projected to fall short of the 7%, the target needed for the achievement of the many SDGs. Several structural factors, including the high debt burdens, limited physical space, weak investment, and the low productivity growth, continue to hinder the economic prospects for developing countries. Climate change and the geopolitical tensions, with their potentially for spilling over the effects into the economic performance, posed additional risks. Despite these challenges, our report highlights concrete pathways in which countries can work both individually and in collaboration to place the world on a more robust path towards the sustainable development. Addressing the debt challenges, curbing illicit financial flows, and strengthening domestic resource mobilization can increase the public revenues for investing in the SDGs. For many countries, the rising global demand for the minerals critical for the energy transition presents an unique opportunity to stimulate growth, create jobs, and reduce the poverty and inequality. Well, dear colleagues, history also reminds us that such opportunities must be carefully managed. Supporting developing countries in leveraging those resources effectively, balancing the economic benefits with the imperatives of the inclusive social development and environmental sustainability can accelerate the SDG progress, not just in these countries, but across the whole world. So, dear friends, the WESP 2025 is a call to action rooted in its evidence-based analysis of the current state of the economy, as well as short-term forecasts. Urgent actions are needed to address the debt sustainability challenges in many countries, especially the countries in the special situations. To close the gap in technology, financing, and infrastructure that hindered equitable growth, and to ensure that the accelerated energy transition reduces climate risks for all of us. The challenges we face are complex, but the solutions are within our reach if we work together. I trust that the 2025 edition of the WESP will serve as an insightful resource, offering the guidance towards the building a more inclusive, resilient, and sustainable global economy. I apologize that I can't be able to be with you to clarify or answer the questions, but I trust that my colleagues would do a good job on behalf of me. So that now I invite my colleagues to share the further details of the report for you. Thank you.
Thank you, Mr. Lee. Yeah, you know you have to leave for another engagement.
Yes.
Thank you very much. I'll hand to Mr. Mukherjee then for some more remarks.
Thanks, Martina. I'd like to follow up on USG's remarks with a few additional details, and I'm organizing what I'm saying around three sort of broad ideas. The first is a little bit about the global economic situation. The second is a special focus on what we are expecting for developing countries, and the third is how do we move forward on the SDGs. So the headline message, which you heard from our USG already, is that we are in a period of stable, subpar growth. And what's notable is that if you look at our forecasts and you also look back at what has been happening, we've had kind of 5 years of growth performance that's below the 3.2% average in the decade leading up to 2019. So this may sound a bit like what we were saying last year, but actually if you lift the hood and take a peek at the engine, things are humming. One of these is that global inflation is expected to slow further from an estimated 4% in 2024 to 3.4% in 2025. And that means in 2025, that's a drop of almost 60% relative to its peak in 2022. And in response, most central banks are lowering their rates. Of the 100 plus that we track, about 2/3 had already done so by the end of last year, roughly double from the end of the previous year. One big uncertain factor is actually the duration and extent of the easing, because inflationary pressures continue to lurk. And particularly since the policy decisions of the major central banks, such as the Fed and the ECB, kind of reverberate across the world, this is a significant source of uncertainty as we enter this year. Nevertheless, the easing has already led to modest turnarounds in investment and in cross-border financing in 2024, which is after a 2-year slump. And we have also seen a significant rebound in global trade. Hamid will, I'm sure, talk about that in both goods and services. Now, that's a global picture, but for developing countries, there continue to be appreciable differences vis-a-vis developed ones. For developing countries, our forecast is 4.3% in 2025 and 4.2% in 2026, remaining well below the 5.2% average in the previous decade. Now, in comparative terms, this gap with respect to the pre-pandemic trend is larger for developing countries than developed countries. In other words, slower to catch up. And while inflation is trending downwards in developing countries too, it remains noticeably higher. It's estimated to be about 6% in 24 and projected at 5.1% in 25. These inflation numbers are 1.5 times those for developed countries, and they've been persisting. And that's a sign of how severe the cost of living crisis is for most of us outside of this room. And, you know, we might say that there's subpar growth in both developed and developing countries. There's been monetary tightening. So isn't there some kind of parity? Well, actually, developing countries face far more severe constraints. In 2024, if you look at the amount of public money that was used to service debt, to pay off interest, the median developing country was 11.1% of its revenues went for this. That's more than 4 times the amount for the median developed country. African countries actually allocated over a quarter of their revenues on average, which leaves very little for meaningful investment in the SDGs. Even among developing countries, as our USG said, there are variations, with the more vulnerable, such as the least developed countries, tending to be systematically worse in relative terms. So what does this mean for the SDGs? All of it is that the prognosis is challenging, although we have had good news, modestly good news, in terms of things like extreme poverty rates returning to pre-pandemic averages. The way forward is not so straightforward. There have been cumulative setbacks over the past few years. Growth expectations, as we are seeing, have been modest, and there are significant downside risks from climate shocks or spillovers of geopolitical tensions. However, at the same time, the overall expectation that there will be stable growth in the midst of all this divergence means that there is really a scope for international cooperation that can combine with individual country efforts. The report has detailed recommendations. My colleague Hamid will be covering several of them. I just want to highlight a little bit more, apart from the resolving the public debt burdens issue, which has already come up and which we expect will be taken up in FFT and other important fora as well, is about accelerating the pace of the just energy transition. So the transition itself benefits all, and if we can ensure that developing countries with the minerals needed to drive the transition can turn these resources into SDG gains, that is a significant win. The reason we're bringing this up is because many of the countries that are identified as having significant amounts of these minerals are also home to some of the largest populations living in poverty and inequality. So if we get this right, it could open the doors to transformative results. Experience with natural resource-led development indicates that such outcomes can't be guaranteed. They can often turn around, but there is a scope for enabling them through multi-stakeholder efforts. For more details and for a much more in-depth look, handing over to Hamid now. Thank you.
Thank you, Shantanu. Good afternoon, colleagues. Let me begin by saying that the world economy is on a stable and steady growth trajectory. Having said that, we need to qualify. Obviously, there are some challenges. The economy is not in the best state of the world. It's not in the worst state either. It's the growth we have projected for this year, 2.8%, and slight improvement in next year, in 2026, to 2.9%. That's for global growth. But 3 points to underscore here. First, that world economy avoided a much anticipated, much feared, as sort of a hard landing that was expected in 2023. And that expectation persisted in 2024 as well, that there can be some kind of a contraction that was avoided.
Not moving the slides. Oh, yes,
And the second point is that post-pandemic growth has already been said that it remains below the pre-pandemic average of 3.2% that we had between 2010 and 2019. And that growth gap is quite significant. And it is a reason for us to look at how policies can be calibrated to boost growth to pre-pandemic levels. And the third issue is that, of course, there are significant, some headwinds that we cannot ignore. One of the headwinds is that uncertainties and trade tensions that we see are already there. We see shrinking fiscal space in many countries, especially in developing countries. And on top of that, we see a growing climate crisis, climate risks in many parts of the world. On the positive side, of course, with inflation falling, we see some monetary easing already began, and it will continue probably in 2025 to a larger extent, and that would provide some respite, some support for stimulating growth going forward. Now let's look at the growth performance across regions. And when you talk about economic growth, we think about what does it mean for economic development. Growth and development are not necessarily one-on-one. When you talk about economic impact or development impact of growth, we need to look at per capita growth performance. And there we see quite a bit of variation across regions. And we see, especially except for South Asia region, in 2024, all the regions had per capita growth rate below their pre-pandemic averages. Most striking was the growth rate that we saw in Africa in 2024, which was almost a half a percentage point per capita GDP growth rate. Not enough to reduce poverty, not enough to reduce all these systemic issues that challenges that we see in those countries. And also regionally, if you look at Western Asia and other regions, Latin America and Caribbean, also growth performance was subpar relative to pre-pandemic levels. We see some improvements in 2025 on per capita terms, but not significant. In some regions, we'll see some improvement, but not broad-based. In terms of the most vulnerable group of countries, we see that states, small island developing states, they did relatively well in 2024 and would probably do well in 2025 as well because of the recovery, quick recovery in tourism in many of these countries. Inflation, I would not go into the details. There's quite a bit of variation between developed and developing countries. Well, that came off. So one of the things that we have to look at is that this trend is, inflation has trended downward across the board with some exceptions, especially if you look at the regional variations in inflation. Still, Africa's inflation is double digit on average, which is still quite worrisome. And also we also see a high inflation in Western Asia as well, 16% average inflation. And with that inflation in many parts of the world, especially where there's a significant amount of poverty, we are witnessing a simultaneous food insecurity problem and a cost of living crisis. And that is the challenge with low growth and combination of low growth and high inflation, where employment job creation is not sufficient to lift the income level of those people, where the inflation is actually cutting back their purchasing power. So a double whammy on both sides. So poverty reduction in many countries, although we have reached the pre-pandemic level of poverty, but it's slow. Poverty reduction, pace of poverty reduction is slow in most parts of the world. Global trade, that's where the good news is. It rebounded sharply in 2024 from reached 3.4% growth rate compared to only 0.9% the previous year in 2023, a massive rebound. And that is was a good news for the global economy, and we expect trade to remain strong in 2025, with some variation, of course. Investment also picked up in 2024, and we continue to expect some investment momentum, especially given the low interest rates probably would support investment in many parts of the world. Labor markets, again, mixed picture between developed and developing countries. Developed countries recovered very quickly from the pandemic-related shocks to the employment. Actually, total employment in developed countries was 3.6% higher than it was during the pre-pandemic period. And same with labor force participation rate. Female participation rate actually increased significantly. But the story is very different for the developing countries. Labor market is still weak. In some countries, especially in sub-Saharan Africa, South Africa, unemployment rate is over 30%. Female participation rate actually went in the opposite direction in many developing countries, from 54% in 2019 to 51% in 2024. And another important indicator or point of concern for us is that youth unemployment in many parts of the world remains very high, elevated. NEET, one indicator that we observe, and not in employment, education, and training, that is also significantly high, in some cases over 25% in South Asia, which is also a concerning trend. One of the consequences of slow growth is that it really strains the fiscal space, because slow growth means slow government revenue growth, and at the same time, debt servicing remains constant or sometimes can increase depending on the cycle of the debt. So we see a significant squeezing of the fiscal space in many parts of the world, and that is worrisome because that is affecting or crowding out other investments and other public sector spending, especially for SDGs. And we see there will be also a pressure, given that high levels of debt, there will be pressure on many countries to cut back spending and go for fiscal consolidation. And we have warned consistently against fiscal consolidation, especially if it's premature, because that can slow down growth further, with further dampening revenue growth and further spending cuts. It can be a vicious downward spiral. So in that respect, international cooperation will be very critical, especially supporting trade growth and also reducing the debt burdens of many developing countries. So the silver lining for our report, we focus on the critical minerals sector. This is a sector where it presents huge potential for countries that are endowed with those resources, nickels and lithium, cobalt, all the minerals that are needed for energy transition. But again, as Shantanu mentioned earlier, that just having resources doesn't give the guarantee that it will lead to economic development. It may give some growth, short-term growth spurts, but may not lead to sustainable development. There, good governance and other factors would play a very important role. And we see that there are many countries that are endowed with those resources. There's a lot of interest in those resources from foreign investors, mining companies, but they have to put in place the right kind of framework to make sure that those resources benefit the local communities, especially the constants of the local stakeholders will be very important to ensure these minerals are benefits are equitably distributed. Labor standards would play a very important role. Here, again, two sets of policies would be important. One is that to keep in mind that there's no one-size-fits-all for maximizing the benefits of the critical minerals. Every country has a specific context. There has to be a country-specific policy, tailored policies, taking into account geopolitical considerations, and national capacity, institutional capacity, level of infrastructure. All of this would play in. But more importantly, there's a significant role for industrial and innovation policies in those countries to make sure that the countries are not just exporters of raw materials, but rather there's a lot of value addition at the midstream and downstream levels. In fact, so that if we are talking about EV materials, so some of the materials should be processed in those countries so that they can get higher value added from those resources. So this is my almost last slide. There's a huge investment gaps, huge opportunities to take increased investment in those resources. Our projected investment needs by 2030 would be close to 150 billion a year, but now is even less than 40 billion. So there's to be a significant increase in investment in those critical minerals, but that would require, again, a better international framework, investment framework. Local conditions has to improve. Conducive policies and institutional support would be needed, but at the same time, a lot of public-private partnerships would be needed to make sure that needed investments are there so that we can accelerate energy transition and support the SDG objectives of many of those countries. So the mix of policies would play a role, as always. Industrial policy would play a very important role in those countries. But I think the last circle is international cooperation. There, I think what we are emphasizing in our report, that there is it's an imperative to strengthen international cooperation, not just for critical minerals, but also to support the broader trade framework, broader investment flows, the capital flows, especially in the context of all the international agreements and international conferences that we have in the pipeline. Financing for Development Conference, FFD4, happening this year. International tax cooperation can play a very important role to prevent the illicit financial flows, and to make sure more resources stay in those countries and support the local development goals. I'll stop here. Thank you.
floor is now open for questions. Yes, please.
Thank you, Martina. It's first, I want to thank you on behalf of the UN Correspondents Association, on behalf of Unca and Valeria Rebecca, who asked me to stand in to thank you. I'm Pamela Falk for CBS. I'm Pamela Falk for U.S. News and World Report. Frozen there for a minute. My question is about the report. You say that monetary policy has eased, inflation has eased, some labor market is better, and yet the percentage of growth is less than the pre-pandemic period. You also said that I think it's 3.5% growth of trade, global trade in 2025. Now, we've all heard in the last few weeks a lot of tariff threats, not just by the United States, but all around the world. In that context, do you see that projection of global trade going down? And the economy, you don't have it in your international cooperation. And what did you base the 3.5% growth? Was it without additional wars or tariffs that would impede that? Thank you.
Great question, but again, we can't model announcements or some tariff threats from whatever country. That doesn't get into our consideration. We actually look at actual policies, which are when there is a sort of a clear indication that this policy will be implemented, then we can change and calibrate our models and to predict possible outcomes. So at this stage, our numbers are based on what we saw as of early December of last year, and we took into account the policies in place without any massive disruption. So again, we cannot, everyday announcements, we cannot take into account, and we cannot constantly change our
If I may,
forecast.
totally understood.
Yeah.
But you two have been in this, and your colleague, the ASG, have been in this for a long time. Do you think these kind of tariff threats around the world can have a negative effect? I mean, I'm asking you to go outside the box or outside your mandate, but I'd appreciate it.
Okay, let me compliment what Hamid said, and Hamid, feel free to jump in. First, a small correction. That 3.4% growth is the actual growth we saw in 2024. So we have not projected it forward to 2025. So 3.4% trade growth is the actual growth in 2024.
But you are projecting 3.2%.
Yes, for next year. Yes, yes. And as Hamid said, a lot of things go into these predictions, but we rely on actual policies. And a big driver of that slight reduction coming up is things like slightly slower growth in the US itself, not because of a sudden change in government policies, but because the average growth in the US has been above mean for a while. So, and when that happens, it comes back to mean after a while. So the US is a big driver of world trade, both in terms of imports and exports. So slowing growth in the US would mean that slight reduction in the volume of trade, among other factors. Now, your question about tariffs and tariff announcements. I think one shouldn't look at tariffs in isolation, tariffs by one country in isolation, even announcements by one country in isolation. I think previous experience shows that people do respond to tariffs in different ways. And so one has to look at what comes out of the wash, as it were, when these moves and counter moves have actually played out. So in our modeling, we prefer to wait for some of these strategic moves by countries to actually play out, and that gives us a more stable basis for projecting forward.
To add one additional point is that any tariff can have two potential effects. One is trade creation, one is trade diversion. And in the net effect, so it could be that there could be some new trade could be created because of tariff, diverting trade away from some other sources. But the total effect on global trade would depend on whether trade creation is higher than trade diversion. So, and we don't know. at this stage, it's too early to predict what will be the sort of as Shantanu mentioned, that tariff, one country introduces a tariff, other country would have a counter tariff, and that may lead to some diversions and some new trade creation. So net effect is still unknown. Thank you.
Any other questions? Yes? And then we'll go online as well if there are any questions later.
Thank you. My name is Ibtisam Azam Al Arab Al Jadid newspaper. I have two questions. One regarding AI and the development in that sector, and how do you think this is actually influencing the economy this year? And then you talked about the right frame work for policies regarding minerals. Could you elaborate on that? Thank you.
Yeah, should I?
Yeah, start.
I think let me take the second question first. On critical minerals, I think in most cases, the policies that would need to be in place, there will be a domestic consideration of the policies in terms of right labor standards, like right kind of human rights framework to make sure we're not using child labor and all this. And that is also a very important determinant of attracting foreign investment, because there is a growing concern for the labor standards. ESG standards will play a very important role to attract investment. But in terms of maximizing or optimizing the benefits of critical minerals, you have to also look at policies that would require transfer of technology to make sure the local partners acquire knowledge and skills and technology over time, so that what they can do with a joint venture, gradually that technology is transferred to the local operators as well, so that they can have more local value addition as opposed to. So these are all part of a larger industrial and innovation policy. We refer to that the policy mix throughout the report. But again, every country has its own way of designing its own policy. On top of the industrial policy, you also need to have a right macro policy framework to support that objective, including how you manage your exchange rate, because often a commodity boom can lead to a massive appreciation of exchange rate that can lead to dampening exports from other sectors of the economy. Agriculture can be affected if exchange rate becomes overvalued. You cannot be competitive in the global market with your agriculture. So exchange rate management is very important. Linked to that also interest rate policies, monetary policy. Fiscal policy plays a very important role also, because how do you share the benefits of those gains through tax policies? How do you tax the local farms or the foreign farms operating in the critical mineral sectors? All of this can play a very important role, and we see some countries have done very well in terms of designing those policies. Other countries are learning from others. So overall, this is a learning process, but what we emphasize that this round, at least countries should try to avoid the resource scars that we had in the past. Like, having natural resources can be not just a blessing, but it can be also a curse. And that's what we're trying to warn against, that you need to have right policies in place to make sure that countries actually benefit from those natural resources they have.
Could I follow up just quickly on that before you answer? Is there any example that you can think of countries who, positive one, who dealt with the issue of minerals and critical minerals when it comes to their policies regarding companies and etc.?
And it depends on the minerals, particular minerals. For example, we can talk about Botswana with diamond, which is not exactly a critical mineral, but their diamond policy was very, very effective in terms of how Botswana became the most successful economy in Africa, graduating from LDC group and being able to deliver a broad-based economic growth. Chile would be another example where it manages copper resources very well and leading to more broad-based economic outcome. Morocco also played a very important role with TSP and other natural resources. So there are many examples of good policies that delivered desirable outcomes.
And these lessons are being translated into practice as well. So, you have sovereign wealth funds, which make sure that your resources, when they're earned in foreign exchange, don't come into the country right away, but are set aside for a rainy day. And some of the countries that have found natural resources relatively recently, like fossil fuel resources, are actually setting these in place. So there is considerable knowledge about this, and the point we're trying to make is that we have to use this knowledge. Not all countries where these resources are located have the institutional capacity to actually implement these mechanisms. And a big part of the international cooperation we would like to see is support for developing those capacities and taking what is well known and putting them in place so that in this new kind of gold rush, we don't find ourselves doomed to repeating some of the problems that happened earlier, particularly with natural mineral-based development. You also asked about AI. So on this, I think there is a good deal of difference of opinion among various experts and among us who study this as well, even within my own team, I would think. Because obviously it's an area that's growing very fast. It's an area where the applications are being developed and the transformative potential is clear. What is not clear is when exactly the transformation will kick in. And I think when we are trying to make assessments about the future trajectory of the economy, that assessment about when the transformation will kick in becomes very important for us. And on this, I think it is not yet clear. Now, if you ask Wall Street, AI movements in AI stock have been one of the major drivers of the S&P. Everyone is excited and will speak glowingly about it because no one wants to see that come down. If you ask economists, they will talk about what the potential for growth is, what the potential for job losses are, what the potential for productivity gains are among people. I think one thing everybody will agree on is that it's really important to be prepared for AI in terms of building up your human capacity, to be able to use AI tools as and when they come along in ways that will boost your own productivity and inject productivity into the economy and help it grow faster. This, I think, is forward-looking thinking that countries have to implement and have to put into place. We've had industrial revolutions in the past where jobs have been lost, other jobs have been created. I think the winner is are those countries that continue to innovate using the new tools and have the capacity to use them to be more productive. Hamid, over to you. Hamid is more optimistic about AI, I think, than I am.
Actually, I think, the AI, like any other shock to the economy, positive or negative shock, you have to think about the distributional consequences. There will be obvious winners and there will be some losers. Some jobs will be lost and some jobs will be created. The question often becomes the most difficult challenge for policymakers is how do you compensate the losers and how do you tax the gainers so that they actually overall, the net benefit would be positive because there will be productivity gains, but it could be that there will be a lot of potential losers from the AI, but they need to be properly compensated or protected from the shock that is inevitable at this stage. We can't turn it back, but we can possibly have the right guardrails in place to make sure the benefits that AI bring, like for example, some of the AI firms, they are projected to grow tremendously and huge benefits, but do we have the tax structures in place to tax the AI firms differently from firms that are using other inputs? For AI firms, the data is the input. But we have no mechanism right now to tax data in a way that really makes it more equitable compared to other firms in the economy. So the question is, again, fiscal policy would play a very important role going forward.
And it seems we have a question on Zoom from Iftikhar Ali from the Associated Press of Pakistan. You have the floor.
Hello, can you hear me?
Yes.
Okay. Thank you very much. I'm sorry I joined very late. All I want to know is the economic outlook for countries in South Asia. Would you please let me know?
Question?
The economic outlook for South Asia.
Economic outlook for South Asia is mixed. There are some good performers or economies of India is expected to grow at 6.6%, if I remember correctly. So, which is India would again be the fastest growing large economy in the world. But then South Asia also has economies that will not do as well in the coming 2 years. Namely, there are some challenges in Bangladesh, given some geopolitical changes that happened in the past year, and that has affected the export prospects. Sri Lanka and Pakistan debt issues are being resolved. If they are fully resolved, there'll be a growth uptake going forward. Again, there are quite a bit of uncertainties there. I think other smaller economies in the region, especially tourism-dependent economies like Maldives or Bhutan, we expect improvements overall because tourism outlook is quite favorable. So overall, South Asia as a region as a whole is expected to do very well in 2025, but again, with some variations within the countries. Among the countries. Yeah.
Okay, and we'll take a last question here.
Thank you so much. My name is Ephraim Kosaifi from Arab News Daily. If I could repeat the same question as my colleague Iftikhar, but regarding the Arab region, especially with the war in Gaza, the events in Syria, and also the developments in Lebanon. How does the prospect for the region look to you in general terms? Thank you so much.
West Asia. Okay, Western Asia, again, we see improvement, some improvement in 2025 compared to what we have. Again, this is based on primarily driven by the increase in oil production in the oil-producing countries in the region. So that is because we expect, especially for Saudi Arabia, the largest economy, would expect oil production to increase significantly in the under OPEC deal. That would give some growth momentum for the region. We also see improvements in Turkey, part of our West Asia, again, a G20 economy. I think that Turkey and Saudi Arabia would lift economic growth for the region. I think we're projecting growth to increase to 3.5% from 2% this year. So oil production. And we would also expect that the ongoing conflicts in the region probably would subside to a large extent, and that would have, again, a growth support for growth. But again, there's quite a bit of uncertainty in the region, and we cannot discount all those risk factors affecting the region, whether there will be further escalation of conflicts within the region. This is very difficult to predict at this stage, but our baseline assumption is that we'll not see further escalation of conflicts in the region. That would mean that growth would be slightly more positive than what we saw in 2024.
I would just add that one thing to watch out for in this region is actually very high rates of inflation. And these are persistent, and they are extracting a heavy toll on people. And we do have in our report some specific growth estimates and figures differentiated across the region, so I'm sure you can find those of value there.
Thank you. All right, thank you to the speakers, and thank you all for joining.